GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
We're chatting with Bob Hoye. He's a market historian and the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, Jim, good to be with you.
I know you're a big fan of checking out the credit spreads because you feel they're a good way of predicting what's going to happen.
They're helpful, and the best thing about it is that we live in a world that really believes that the central bankers can run things and by generally lowering interest rates, and they've been lowering interest rates terrifically. But within the credit markets, you have the difference between, for example, investment-grade bonds and junk bonds. And that's the spread, the credit spread there. And you also have the difference between long-dated, for example, treasuries, and short-dated ones, and that's another spread. And while they have pushed interest rates down at the short term to zero, and recently long treasury rates down to an unbelievable low, over all the decades of central banking as exampled by the Federal Reserve System, when it's time for change, they have no influence on credit spreads and the yield curve, because it just is the way it works. So there's a tendency to borrow short and lend long when there's a party, and then when the party's over, you've got to reverse those positions. And then also in buying spread products, in a party, there's lots of confidence, so you can buy junk, very risky stuff, and that's all right. And then that changes. So what we're looking at here now is that the Treasury curve has been flattening for a year. And in the past, like certainly the work that we've done back in the bull market that blew out in March of 2000, we emphasized beginning in January that year that the curve could reverse after, somewhere around 12 to 16 months. And the 12 or 14 or something like that counted out to that March of 2000, and that turned out to be the speculative high. And then in 2007, the party in credit markets counted out to ending perhaps around that May or June. And indeed, in May 2007, you had the credit spreads reversed to widening, and you had the yield curve reversed to steepening, and that's what pushed off all the problems. So what we're looking at now is that it's 12 months since the curve has been flattening, and it's beginning to change a little. And you've had a terrific run at narrowing of credit spreads since the disaster ended with a panic in January. That was against, very weak commodity prices, including the crash in crude oil down to 26. So it's been party time in the credit markets, And we're just doing some work here now on the spreads, and you can sort of say while the action is getting pretty impetuous, we're not quite at the end there yet. And as I also said just a few minutes ago, the yield curve is turning a little. So this says that the party that's been on since the disaster ended in January is now getting kind of old and mature. And if you're dancing with the music, you should start to look at the exits just to know where they are. And of course, what will be the trigger on this would be crude oil, which rallied from 26 to 51 and change. And then we were looking, that was in May, we were looking for a correction. Now that correction has gone on, and then in the last couple of weeks it's firmed up a little. And this firming on crude oil can run into August, and same thing with perhaps the firming up of some of the other commodities, base metals and things like that. But Jim, you know, it's all very precarious. You've never had such an unnatural speculation by central bankers in trying to affect policy. And just writing here this morning that, you know, when you look at when markets get impetuous, you know, the lemmings are there, and the long U.S. Treasury bond became highly speculative until about 2 weeks ago. And who have been buying long treasuries? Well, central banks around the world. And it's became very compulsive and gave us our upside exhaustion signals, as well as a sequential sell. And there's been quite a drop in treasury bond prices. And now you have the same compulsive action in lower grade stuff. And as I say, it could run for a few weeks, but it is very, very compulsive behavior. And again, you've had the central bankers buying the stuff, and they're acting like lemmings. And the really dreadful thing about it all is that these lemming central bankers are playing with the taxpayers' money, because ultimately, for all of this speculation, when it goes bad, the taxpayer is going to be on the hook. Governments will be owing immense amounts of money, all inspired by, some central bankers who have theories that have been around for hundreds of years and never worked. But it seems that it takes a new generation of central bankers to get enthused about bogus theories, and then it takes another generation to realize that they don't work. And so this is going to be fascinating over the next few months to see how all this turns out. But at the moment, the speculation in the credit markets is really hinging close to the price of crude oil, where it's going, and it's also hinging upon the U.S. dollar. And for a couple of days, well, the last few days here, the U.S. dollar index is working on breaking out above the 200-week moving average, and this would be quite a step to have it fully break out, because that's what in 2014 anticipated the peak of a lot of commodities, and then 2015 pushed off the problem in the Shanghai market. So we're watching it very closely, and it is, let's call it, the central bankers are haywire, and the credit markets are precarious. So watch the price of crude, and it's weakening as we speak here now.
We'll have more with Bob Hoye right after the break.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, Japan has just announced a $188 billion U.S. stimulus plan. Construction, of course, is going to be big. They're going to build their maglev train. I mean, I thought their trains were fast already, but apparently they're going to expand that, and they're going to encourage Japanese construction companies to do business outside the country. So perhaps a stimulus plan for the rest of the world.
Well, they hope so. To me, it's still fascinating where you have central planners get up there and they know that this would be a worthwhile event, and then they think they can make it happen. Well, I've been on the trains in Japan, and they are outstanding. And how many billions will it take to convert those rapid high-speed trains to maglev, which is a magnetic suspension? It doesn't run on wheels. It runs on magnetic cushions, let's call it that. And those require very precise tracks, let's call them tracks. And I don't know how much re-engineering of the main structures they have to do, but hey, if they think that a contraction can be deferred by artificial spending by the state, it's best to keep in mind that if the government is spending it, then businessmen are not, except those favored by the state who may be participating in the scheme. And go back to 1989, the 80s. 1990. When the Japanese bubble blew out. Prior to that, their main central planning authority, called MITI, M-I-T-I, was considered to be the greatest thing ever invented. It was fabulous. Everybody believed in it. And now, since 1990, these same policy-making agencies have been trying to reinvigorate a boom in Japan. Not happening. So now it's interesting that the things you listed that they were going to do, one of them is perhaps they can find work and projects in other countries. So does this indicate they've given up on trying to stimulate their own economy and are going to try and do somebody else's? No, I think they're just clutching at straws. But what we should look at here too is the general commodities. Out of the disaster in January, which the crude oil ended on a seasonal low, which we were looking for, and then the rebound. And we got a correction. We had the correction, and now we're looking for the strength to continue into August, and anything we can get would also be helpful for other industrial commodities such as base metals or lumber. But all of this is just very near-term stuff, and with any decline in crude oil prices, and it's sort of down 81 cents here as I look at it now, that really changes the tone in many markets because it changes the ability of a beat-up petroleum sector to service its own debt, and you have you have the default rate is climbing tremendously, and that is a calculation that includes all corporate debt, not just energy company debt, and that's climbing. This is climbing up to where it was in the 2008 recession. I mean, this is serious, a serious default rate. And at the moment, or at least over the last few weeks, the firming price of the crude oil and steadiness in base metal prices, maybe slightly firmer, has been very helpful, because it's the same old thing throughout history, is you have to have good prices for your products in order to make some money, and you want to make some money so you can service your debt. And if your pricing power is going all to hell with products going down, then you're not making so much money. And if the prices of your products fall too far, then you're actually losing money and you can't service the debt. And then what happens then is the credit rating agencies come in and say, oh, we're downgrading you and we're putting you on a negative watch, da-da-da-da-da-da. It's as old as the hill. So while it may be comforting in the last few weeks to have a firmer crude oil price, it isn't going to last all that long. And you know that often if you have fully inflated credit markets, highly speculative conditions, and it doesn't matter who's been buying this stuff, that if there's going to be a discovery of insolvencies and inabilities to service debt, it's usually discovered in the fall of the year. And if you look at seasonality in the stock market, September is frequently a bad month and October not so bad. But you have to be aware of the possibility of change, and you look at the party in long bond, long treasuries, and the amount of action there's been in credit spreads since January. I mean, all of this is what my mom used to say decades ago. It's an accident looking for a place to happen. So if you know the seasonality of financial markets, very good times, party, out to around May or June. Hey, we've had that. And then the other one is you can discover bad things in late September and into October. I think the bad things would be widening credit spreads, weakening commodity prices, and a firming dollar. And so we'll watch for that, which then makes us look at the precious metals and fabulous rallies, lately a little overbought. So we are in a cyclical bull market for the precious metal sector, and there can be some corrections in the major trend. Our view is that when you're in a cyclical bull market for something, you buy the dips. So, but you're also aware if it gets too overpriced. So I think the next 5 or 6 weeks are going to be very interesting in the financial markets.
Bob, thank you so much for chatting with us.
Jim, it's always good to be with you.
Have a great weekend.
And you too. You're heading up into Alberta for a family reunion?
Look out, Sylvan Lake. The Goddard plan is on the way.
Very good. Okay.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. You can forward questions to info@HowStreet.com. Bob loves to answer those questions. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.